Welcome to this month's Financial Security webinar. We are delighted to have with us Andrew Zumwalt. Those of you who have been in our community for a while probably remember Andrew or have met him through the Financial Security for All community of practice. His title for his presentation today is A Tenacious Trek Through Tantalizing and Timely Tax Topics, a presentation on the current and relevant past tax law affecting tax filers in 2021. So Andrew is one of our resident experts in the community on tax things. And you may know of his Mo tax program in Missouri. Get it? Mo for Mo and taxes. He works through the VITA sites, the Tax Preparation Assistance Program, and they do tax filer education. So it's not only that tax filing service, but also uses that as an avenue to share some financial literacy education. Over the last 6 years, they've assisted more than 20,000 filers and have obtained refunds for those tax filers of more than $20 million. Andrew has a MS degree and he's a certified financial planner. He's associate extension professor, associate state specialist, and co-director of the Center for Economic Education at the University of Missouri. We're so happy to have him here today. You can find resources for this presentation on our webpage at uaex.edu/money. So thanks so much for joining us. And without further ado, here's Andrew.
What an introduction. Thank you so much for that. So a tenacious trek through tantalizing and timely tax topics. What a year it has been. We started out in 2020 kind of looking at the Secure Act that passed a lot of changes there to retirement. And then we thought, 2020, just another year, right? Okay, here we go. And then we saw the tax season kind of get cut short as coronavirus came in and the lockdowns affected us. I'm actually at one of our VITA sites today. It's actually operating with another site manager right now, but it looks vastly different from what we had last spring. We're doing a drop-off service. People are coming in, filling out some paperwork, dropping off their tax forms, and then they're going to come back in a week and pick them up. And that's really to create some distance between our students and volunteers and the clients to make sure that we are kind of following those guidelines. And it's required so much of a change in how we operate. So it makes it easier for maybe myself to understand maybe other service industries who've had to go through changes in working with clients kind of on a one-on-one basis. And so just such a different atmosphere. But let's talk about some of the changes that came through in March and then in late December of 2020. And especially looking at it from the lens of maybe a client or what a layperson might understand. Because over the past few weeks, I've had lots of conversations with people and some folks don't seem to understand what that tax law did at the end of 2020. So we're going to dive into some of those topics. Okay, a little bit about me. We heard about all that. So have been with MU Extension for 15 years. Love what I do, and so just glad again to be here. So just a refresher on the CARES Act. And so that law had a lot of changes in it, a lot of different items, especially funding for states, local governments, et cetera. But from a personal finance / tax standpoint, just a little bit of a refresher. No required minimum distributions for 2020. And of course, there's an asterisk there. We'll talk about that. But in general, no RMDs for 2020. So a lot of retirees were happy about that. Relax the rules on distributions and loans from retirement plans. And so Congress realized that, hey, people are going to have to be drawing on these retirement plans. Let's give them some options. And so we'll talk about what options people had. This new charitable adjustment, so $300 in cash donated to charity. This one really, I think it's great for people to have this opportunity to be able to reduce their taxable income by this $300 adjustment. But we've been telling people for years, ever since the standard deduction doubled, that they don't need to track their charitable contributions anymore. Don't worry about that. It's not a big deal. You're not going to itemize. If you're married filing joint, it's $24,000+. And unless you have a lot of charitable deductions, a very large mortgage, or I would have said lived in a state with a lot of taxes, but we know that you're limited to $10,000 that you can itemize of your state income and sales taxes, et cetera, the SALT cap as it's known. And so really nobody's itemizing unless they use some strategy. So maybe they're bunching up their charitable contributions, maybe 5 years worth of charitable contributions in 1 year, and really taking advantage of the ability to bunch that up. And so we've been telling people don't keep track of it, and now there's this option to be able to deduct 300. And then also expanded the qualifying expenses for FSAs, HSAs, and HRAs. So talked about this as well, but I think there's still a group out there that needs to hear about this. So no RMDs for 2020, and that includes inherited accounts, right? And so the Secure Act changed how we deal with inherited IRAs and other retirement plans. So before Secure Act, you could take that money, let's say you inherited an IRA, you could withdraw that over your lifespan. And now that's not the case. It has to be withdrawn within that 10-year period of time if you inherit a retirement plan today. So no RMDs for 2020, including those inherited accounts. So that was really nice. The exception did not apply to money purchase plans or cash balance pension plans. And so in general, it was all retirement plans except for these little asterisks here. But many people don't have those types of plans. And so in general, we saw a lot of discussion about being no RMDs. There's been talk about it for 2021. You know, do we want to have people take their RMDs for 2021? And as of right now, you do need to take an RMD, but right, that could change. We've got a new administration, new president, new Congress. Everything's different, but we don't have any news yet on that. Those retirement withdrawals, if you took them out due to coronavirus, you can have that distribution prorated out over 3 years, so you don't have to include the big lump sum that you took out in just 1 year's worth of income, where it might kind of push you up into different brackets or make you ineligible for certain tax benefits. And so you can take that out over 3 years. And in fact, you can also repay it. And if you repay everything within that 3-year period of time, you can amend your taxes to remove the evidence of the withdrawal. And so very lenient here with retirement plan distributions. It does only apply to 2020 distributions, so you can't, doesn't apply yet to 2021 distributions, and really haven't seen anyone talk about extending this provision to distributions in 2021. All right, here's the charitable adjustment. And so if you've looked at a 1040, right, because, you know, some people are on the listservs where a new 1040 comes out and they just run out to see what it is on the IRS website. I know everyone on this presentation today is already on those listservs, but just in case you missed it and didn't see it, there it is, line 10 on the 1040 page 1. We've got our adjustments to income. Schedule 1, line 22 is the sum of all your adjustments from Schedule 1, which is where the adjustments live. And then 10B is where they kind of slipped in the charitable contributions if you take the standard deduction. And so you can see that this year, your $300 is a 4 AGI calculation. So you're going to take that $300 out before you come up with the AGI number. So it is technically an above the line deduction. It has to be cash to a qualified charity, so you can't give appreciated property. And it has to be a qualified charity, which generally is most charities, but you want to be specific and say it's not a donor advised fund. So if you've got a donor advised fund with Schwab or Vanguard or Fidelity or your local community fund, those contributions don't qualify. So it has to be to a qualified charity. And that $300 limit, you know, there's been so much confusion. I seem to get a lot of questions about this as well. This $300 is for all filing statuses in 2020, right? In 2020 here with the asterisk. And so we are seeing people asking about that. Married filing joint is not 600 for 2020, right? And so we'll talk about that in a second, how that's a little bit different for 2021. Okay, FSA, HSA, and HRA changes with the CARES Act. The definition of qualified medical expenses were expanded. And it's important to note this was expanded only for FSAs, HSAs, and HRAs, itemized deductions, your medical expenses did not change. But here we've got the qualified medical expenses were expanded for the FSAs, the flexible spending accounts, health savings accounts, and some health reimbursement accounts. So over-the-counter drugs are now reimbursable. So what does that mean? Well, your acetaminophen, your cough syrup. I've got a two-year-old now, but was just a little bit over 1 when this law passed. And so she still was getting diaper rashes. And so we had to buy the butt paste there to kind of dry that up. And not only was this now reimbursable, but it went back to January 1st. So if I had bought any cough syrup or acetaminophen or other items in the early months of 2020, I could submit reimbursement for that to my FSA provider and get those products reimbursed. Also, big news for this law was that menstrual products are now being reimbursable or are now reimbursed as well. So tampons, pads, liners, cups, sponges, or other similar products used by individuals with respect to menstruation, all of that is reimbursable. This has been, if you follow kind of tax history, this has been in the works for a long period of time. Excuse me. Some groups have been fighting for this for years. And so it's got slipped into this legislation and it is now law, and it's making a lot of folks very happy for this inclusion. I've been doing these presentations. I think we did over 20 CARES Act presentations, and I had a mom jump in the chat and she said, you know what, I've got 3 daughters. You've just saved me a ton of money. And I was like, I'm glad to help you, glad to serve. So be sure to kind of track those receipts, submit that, and get those items reimbursed. It's always interesting what people put in chat sometimes. So that's a little bit of the CARES Act refresher. Let's talk about the economic impact payments. That was also in the CARES Act. So much confusion around these. Some people still haven't gotten their payments. So there are some, there's people that are kind of working through these items. In general, if you were married filing joint, you got $2,400. Every other filing status got $1,200. So basically, married filing joint, primary, and spouse, you got $1,200 each. And then per qualifying child was an additional $500. And those rules were the child tax credit rules. And so you might have a qualifying child for dependency purposes, but maybe they were a college student, maybe they were 20 years of age. They weren't child tax credit eligible. And so even though they're a qualifying child for dependency purposes, it's not going to get you the $500 for the child tax credit rules. And again, the biggest stickler there is you have to be under 17 years old by the end of the tax year. So who's eligible, or who was eligible for that $1,200? Well, really everybody was eligible, including the homeless. And so if you had some folks that have kind of fallen off the radar in your community, and they've haven't filed tax returns, they're not collecting Social Security or other kind of benefits, as we'll talk about in a second, they're eligible for this $1,200. And we'll talk about how you can help those folks kind of receive the money. And so early on, here in Missouri, we worked with some homeless advocacy organizations in the urban areas to try and help them get the word out that, hey, if you haven't filed, if you've kind of, again, fallen off that radar, you can actually file use the non-filing tool on the IRS website and actually get this $1,200, which for a person who may be experiencing homelessness, may be something that could really drastically change their situation. Also including the incarcerated. Very interesting history around the incarcerated. Originally, the IRS said, no, if you're incarcerated, you're not eligible for this money. But when you went back and looked at the law had nothing about being incarcerated and being ineligible to receive these funds. And so the IRS was kind of poked and prodded by different people to say, well, why are you doing this? And then they kind of turned around and said, no, okay, if you're incarcerated, you can get the $1,200. So really it is everyone, except the most common folks who couldn't get this $1,200 are dependents. So that college student we just talked about who doesn't make you eligible for an additional $500, they don't get their own $1,200 either. And so a lot of people thought this was kind of unfair. You've got a qualifying child for dependency. It's not child tax credit eligible, sure, but wouldn't that situation provide another 500? And so the law said no. And so if you have a dependent who isn't a child tax credit eligible dependent, they're not going to generate an additional $500 in stimulus payments. Non-resident aliens were left off that, as well as high income filers. And so generally everybody got the money, but there were some folks who were kind of left out of the system. So how did the IRS determine who to send this money to? Well, this is fascinating. And so it was the IRS looked at your 2019 taxes and said, okay, we looked at your 2019 taxes. It looks like you and your spouse filed. Your income was below the phase-out ranges, and you had one child tax credit eligible person. So that's $1,200 for you, $1,200 for your spouse, $500 for the child, for a total of $2,900, right? And so a lot of people had already filed their 2019 taxes, and so the IRS looked at the 2019. Now, 2019 taxes, some of them weren't filed, right? The deadline was actually extended to July, and so the IRS looked at your 2018 taxes. And if you didn't have 2018 taxes for whatever reason, they went and looked at Social Security, where you're receiving Social Security retirement income, Social Security disability income, were you receiving supplemental security income, or SSI? And so if you were receiving that, then Social Security Administration worked with the IRS to provide that information and then get those payments out to folks. And it's very interesting. We had some recipients of Social Security who were young, and they're actually in the kind of foster system here in Missouri, and they received $1,200 payments because they're receiving Social Security benefits as well. And so very interesting how that all played out. And then if you didn't have Social Security or SSI payments coming, then veterans benefits. The VA worked with the IRS to make sure that veterans also received the payments. So if you didn't have any of this, then you truly were kind of off the radar and you didn't get the money. And so we'll talk about in a few slides how you should file 2020 tax return and get the recovery rebate. But this is how it all kind of shook down. And so we'll see here in a second what happens in a scenario with the non-custodial parent and the custodial parent and a child who shifts between returns every year. So first of all, important to note, there's no clawback provisions in the law. And so if you claimed a child in 2019, as we'll see here in a second, and you don't claim the child in 2020, you don't really have to pay anything back. There's no provision to pay money back, except there might be for if you received an economic impact payment for someone who wasn't alive in 2020, right? And so they looked at your 2019 tax return. If someone had, or 2018 or 2019 tax return, if someone had died before calendar year 2020, then you might have to repay that economic impact payment. The IRS was saying early on that if they died before the payments were mailed, regardless of whether it was 2020 or not, you'd have to repay it, and they actually provided some instructions. A lot of people said, whoa, hold off on that in the tax prep community, and Congress clarified that quite a bit in the most recent December legislation. So if someone dies in 2020 or has died in 2020, in general, it seems that the surviving spouse or the estate will get to keep that economic impact payment. Seems to be what Congress's intent. So no clawback provisions, except for maybe if a person died before calendar year 2020 and an economic impact payment was generated. All of this will get reconciled on a 2020 tax return. So for most people, they received their money. We're going to go into the software. We're going to put that amount they received in, and they're not going to get any additional dollars. But let's say that the calculation for 2020 was actually less than what they received. They don't have to pay that back. And here I've got on the 1040 page 2, line 30, recovery rebate credit. I know most of you, again, when it was in draft form, went out to the 1040 page 2, and I've already seen this line, but I just wanted to put it out there for, there may be a couple of you who haven't, you're not going out and looking at the 1040 every week, but that's okay. It is also called the recovery rebate credit. And so we've got the economic impact payment, often called stimulus payments, that is now going to be the recovery rebate credit. And I just, why can't these names be similar? Why can't we just call it the same thing? Or or just tweak maybe the last word or something instead of just everything being different. My goodness. So let's look at a non-custodial parent and a custodial parent. So we've got the non-custodial parent and the custodial parent. So this is a divorce situation, and the divorce decree says that the child moves between tax returns every other year. So the non-custodial parent claimed the child in 2019 and filed that tax return before the CARES Act passed. And so the IRS, when they looked at the 2019 return, said, okay, it's you and you've got this child here, so we're going to give you $1,200 for you and an additional $500. Here you go, $1,700, right? If we assume the custodial parent also filed their 2019 taxes before the tax law passed, the IRS looks at the 2019 return, says, okay, it's you, and we don't see any other children here, so we're going to give you $1,200, right? And so when the custodial parent is claiming the child for 2020, because again, it alternates every other year, they're going to receive a recovery rebate credit based on that same child. And this is blowing some people's minds. They're like, wait a minute, you can get payment, two different people can get payment for the same child, and that is according to the rules, yes. There is no clawback provision here in the rules, and so that money will be paid out to the custodial parent because they're claiming the child on their 2020 tax return. And so that custodial parent will receive $500 for that child, plus, I haven't said it specifically yet, but they'll get the second stimulus payment as well, right? That non-custodial parent, when they file their 2020, they're not going to have to repay anything because, again, no clawback provisions. And that is confusing for a lot of people. I've had quite a few people call me and say, well, wait a minute now, am I going to have to repay this? Or my ex-spouse claimed it last year. Does that mean I don't get it this year? And we've had a lot of discussions around this. Right, so your recovery rebate credit is going to be based on your economic stimulus payment or economic impact payment. And so how will people know? How much they received in stimulus payments, right? Because the software is going to ask for the amounts. How much do you receive in the first round of stimulus payments? How much did you receive in the second round of stimulus payments? And it will use those numbers to compare what is generated from the information on the tax return, the recovery rebate credit, versus what you've already received. And if you're supposed to get more, you'll actually get more on your tax return. Well, everybody probably received a notice 1444. And so you probably received that sometime late spring, early summer. And so looks like this is the one that came to my household from the White House in Washington to my wife and I here. Notice date of May 22nd, 2020, notice number 1444. And that's key. Everybody received a 1444. And in fact, I took mine and I put it in a frame, right? And I put it on my wall here to kind of, it's the one thing I have that I received with Donald Trump's signature here at the bottom. I know that might be mirrored, so you may not be able to read it. But this is what I received. Every Zoom webinar needs to have a prop. So this is my prop for this webinar. And I didn't actually, I put this in it this morning. I did not hang this on my wall. That's a bit much, but every Zoom webinar needs a prop. This is what it said. I'm pleased to notify you that as provided by the CARES Act, you are receiving an economic impact payment of $3,400. So my spouse and I get $1,200 each. That's $2,400. I've got 2 kids. That's $1,000. There's the $3,400. It goes on to say all this neat stuff here. Great. What it should have said, and it never did say, is you need to keep this letter because that's going to help you when you file your taxes, right? If you know how much you received, then you don't need the letter, that's fine. But I've already talked to some people this morning when I said, how much did you get? They're like, I don't know. I'm like, well, how much did you get? And they're like, I don't know, I got some money. And so there's some folks who don't remember how much they received in economic impact payments. And so we're gonna have to kind of work with them to figure out maybe what they should have gotten and then start with that and figure out if they actually got it or not. If you didn't get a 1444, I'm very sorry. It's a one-of-a-kind letter. I can't send you mine. but you don't necessarily need it. If you know how much you got, you can go back and look at your bank statements. Then you're fine. You just need to know that amount. But I can tell you that some people, they didn't keep the letter and they don't remember. It was a long time ago for folks. And so it's going to be interesting to work with them to figure out, okay, how much did you actually receive? Some folks, I'm kind of keeping an eye on chat. Some people received these economic impact payments on debit cards and they thought it was a scam and they just tossed them, and it's just, it's not good. Some people had some problems where they had their refunds deposited into accounts that preparers would use to then issue a check so that the person would get their money quicker. And so there's a lot of confusion on these accounts, and this has not been the easiest rollout. And so the IRS is still kind of working through some of these issues, and it's the middle of a pandemic. And so I feel for the IRS a little bit, just a little bit. There might also be some times where your recovery rebate credit is higher. For example, if a child was born in 2020, just had a client walk through the door this morning, and they made sure to tell me, "Hey, I had a child born in 2020. I didn't get that money for that child." I'm like, "You're absolutely right, you didn't. You're going to get an additional $500 when you file your taxes, and plus the $600 from the second round." And the client knew that, was aware of it, and wanted to make sure that I was aware of it as well. But there might be some clients who don't know that. And so child born in 2020, that's going to give you some additional income or additional recovery rebate credit, because the IRS doesn't know about that child until you file that tax return. If someone's income was higher in 2019 than in 2020, the IRS looked at your 2019 return first, as we talked about. And if your income was above the phase outs in 2019, maybe your economic impact payment or stimulus payment was less. There was a reduction there. Well, again, it all gets reconciled on 2020. So if your income is below the phase out in 2020, you're going to get some additional dollars as well. And a lot of people we know have suffered maybe job loss or a decrease in wages per hour or a decrease in hours. And so a lot of folks who may have maybe been above that phase out are now going to be below, right? Or if you've got a new dependent that qualifies for the child tax credit. So maybe you've got a niece or nephew that came and lived with you during the kind of recession that we had, the economic fallout. And so that person kind of newly qualifies you, and you can get the recovery rebate credit on them as well. So all of this is going to result in a higher recovery rebate credit. You're going to tell the software, this is how much I received. The software is going to look at your situation and say, okay, this is the child tax credit eligible people in your household. This is your income. This is your filing status. Here's what we think you should get. And so if that number is higher than what you received, you'll get the difference. If it's lower, no clawback. You don't have to pay it back. So round two. So we've had the economic impact payments come out in May or so, or in that early spring. Round two came out. It was signed into law late December. And so for most folks that I talked to, a lot of them who had direct deposit, they got their money on the 4th of January. The money was there. I prefer to get checks just because direct deposit scares me sometimes. I'm always worried I'm typing my number in wrong. And so with direct deposit, if you type, just to kind of go off a little bit, if you put in your routing and account number on a tax return and you transpose some digits, there are check digits, which are really cool. If you, later this afternoon, if you Google check digits and check, you can find some awesome YouTube videos that explain how check digits work, and it's really awesome if you're into that thing. But there's some safeguards to help someone if they transpose numbers and their routing or their account number. But if you transpose something and you do it just right, you can actually come up with a real routing and a real account number. And if your refund, the IRS will look at that and then actually take your refund and send it to those numbers that aren't your numbers, but are somebody else's numbers. There's no provision to get your money back. You told the IRS, put the money in these accounts. The IRS did that. What do you want the IRS to do? And so you've just basically made a gift to that person of your tax refund. There's no way to get it back. And so that just gives me chills. And so personally, I choose to have a check sent to me. because of that, I got my stimulus payments via check. I'm pointing to this letter that you can't see over here that's in the frame. And I got my check last week. I checked the tool. It said I was going to get it, or said it was mailed on the 6th, but I got it just last week. I think the Postal Service is a little overwhelmed. I've talked to some folks out there, and there is just a big backlog in certain places. There's still, the checks are still coming, basically. So round 2, $600 per primary and spouse. So $1,200 for a married filing joint couple, and then $600 per child, which is a little bit more than before. That follows the child tax credit rules. So another thing that people are confused about, I received this money in 2021, so that's going to go on my 2021 return, right? Like that's how it's all going to be figured out. And it's not. It's actually, you're receiving in 2021, but it's going to be reconciled on your 2020 return. And I've had some folks really struggle with that. So wait a minute, I got the money in 2021, so it should go on the 2021 tax return. And I'm like, yeah, that's completely logical. Makes perfect sense. But taxes may not be logical. And so I just, like the emoticon here, whatever, I just give a little shrug. I'm like, you know, in the law, it's actually reconciled on your 2020 return, which makes sense because the IRS is going to, or has stopped sending out payments. And so the checks may still be in the mail, but they've stopped January 15th because it's going to be faster for you, if you haven't gotten the money, to just reconcile it on your tax return. And just get the money in the recovery rebate instead of trying to work with the IRS to get that second stimulus payment mailed out to you or direct deposited. And I've actually got a great example here. My mother passed away in 2020, and my dad received the first economic impact payment. But when I went to look up his status for the second one, it said status not available. And so what I'm thinking is the IRS is like, oh, we've had a death in 2020. We're just not even going to send anything. And so he's going to actually reconcile all of this when he files his tax return. It'll be the final tax return for my mom, but it's going to reconcile all this recovery rebate credit stuff. But the IRS has basically said, you know what, we're just not even going to send that second payment. So just something to be aware of with folks. So again, when we file that recovery rebate credit, we're going to need to know what the first round was and the second round. And some people, today, the clients that have walked in the door, they know how much they received first and second round. It's great. Some people don't. And so we can reference the 1444. A lot of people threw that away, or they shredded it. And so we need to kind of work with folks to figure out, okay, logically, what did you receive? Does this sound about right? Look at your bank statements, et cetera. There should be a second notice, a 1444-B, that is going to be the payment you received in the second round. But again, has anybody noticed a slowdown in the mail? I mailed some holiday cards about the 28th, and my friend in Pennsylvania received them about 2 weeks later. And I've sent him things before, and it's gotten there in about 4 days. And so I think we're noticing some slowdown in the mail. I mailed something yesterday, and I said, yeah, there's, I was talking about the IRS and how the IRS has been slow as well. And when I talked to the postal clerk, they thought I was talking about the Postal Service, and they said, yeah, there's trailers piled up in cities all around the country with just mail in it, and they're working as fast as they can. And I'm like, still? And so there is still this slowdown. There's mail it's just taking a little bit longer. So if you haven't received that 1444-B, or if you haven't got your second payment, it could still be in the mail. You know, it would be great if there was a way to look up how much a person received in terms of stimulus payment. And if you've been thinking that as I've been talking and kind of relaying the troubles that people are going to have, and you're like, Andrew, there's going to be a lookup tool, right? To just look this up. Remember Making Work Pay from about 10 years ago? We could go online and see how much someone had already received in their Making Work Pay credit, and then use that to reconcile on the tax return. The IRS has said that there is going to be no lookup tool. And so you can't go out and, as you can with the get payment status, look up and see where your payment's at. You can look up and see if your payment was sent or not, but you can't actually look up the amount. There is no tool for that. The IRS's answer is, well, you can just go out and use the account transcript tool. which I've got another little emoticon here. This guy is flipping the table over, because if you've ever used the IRS account transcript tool, you have to set an account up at the IRS, and it's not horrible, but it's a little bit less than horrible. It's not the easiest thing to do. So I know a lot of our clients are generally struggle with computers and accessing accounts. And so using the IRS account transcript tool will just be a step too far. And so we'll have to use some trial and error to figure out exactly what their first and second round stimulus payments are going to be. Yeah, we've got some folks saying some of my mail has taken more than a month to get to me. Yeah, I was talking to the folks, and the postal clerk said that there was some mail that was sent late November, early December, and the system got overwhelmed. And so that mail from that time period got put into trailers, and it's still sitting there because they just, instead of making everybody wait and delay everybody, they just delayed that mail, and they tried to keep the present mail flowing through the system. And so there might still be some mail from that late November, early December timeframe that hasn't made it out, is what the postal clerk said. So we could notice some significant slowdown in mail still. One of my, a volunteer that I work with was able to talk to an IRS official in December because they kind of crossed paths a little bit. And there are apparently a lot of mail trucks outside of the IRS processing facilities because the mail comes in, they open it up and they scan it, and then other workers kind of process that return. And so if you do an amended return, for 2019, those can be done electronically, but for prior years, those have to be done on paper. The IRS is still mailing people CP 2000 notices that say, hey, we think you owe this much based on information we received, like there's a W-2 that you didn't put on your tax return, et cetera. And those are still going out. But if you try and reply, some of that mail is getting stuck. It's not going through. And so I think it was about 50 mail trucks were outside of the IRS processing facility, I think in Tennessee. And so just imagine 50 tractor trailers full of mail. And I saw a quote, I think in late December, that there was about 10 million returns that still need to be processed via mail that they estimated. And so IRS is really, I think they're doing a great job in trying to get people this money through the economic impact payments and the stimulus payments, et cetera. But they've got a lot to kind of catch back up on. And so it's going to be a lot of patience required if you're working with the IRS, I think.
I have one question here in the Q&A. It says the changes in FSA, Hsa reimbursement for over-the-counter and menstrual products, are those permanent or temporary?
Yeah, those are permanent. So absolutely, that's a great question. Those are permanent changes. And if you can think back about 10 years or so, you used to be able to get reimbursed for your over-the-counter drugs. So your acetaminophen, ibuprofen, et cetera, those were reimbursable, and then they took that out. Menstrual products were never reimbursable, and they're now reimbursable as well. So that was a permanent change. They're in there, and I don't see them taking that away within the next couple of years. I think that's going to be, it is permanent, and it's going to be around for quite a while. People really like that change.
Okay, thanks, Andrew. Those were the only questions that we had at this time. All
right, well, let's keep moving then. So let's look at some other recent tax changes from the December legislation. Some of the key things that people need to know: you can carry forward your FSA balances. So I actually have a somewhat large amount in my health FSA because I thought, well, I was going to spend more than I actually did. And so my employer lets me roll it over for 2.5 months. So I have until March 15th of 2021. But with the December legislation, my employer can choose to let me carry forward my balance from 2020 for the entirety of 2021, which I'm excited about. My employer hasn't told me they want to do that yet or will do that yet, but I hope they do. And in fact, the law actually extends that. If you have a balance in 2021 and your employer lets you do it, you can roll that into 2022 from the end of 2021. And so that's really exciting. That is for health FSAs and for child dependent care or dependent FSAs. If you're paying for daycare or adult daycare, that type of thing. And so really exciting, but again, your employer has to opt into that, has to choose to do that. And so if your employer doesn't, then you may be stuck with the 2.5 months or being able to roll over a smaller amount. I think it's about $550 is the limit. So Congress kind of unlocked the door. Employers must choose to open it. I see a question has come in from the Q&A. And so let me answer that real quick because it is about the recovery rebate credit. A college student was claimed as a dependent in error on her 2019 return. Her parents did not claim her as a dependent on their 2019 return. Can she receive the recovery rebate on her 2020 return? Absolutely. So if a student claims themselves in their 2020 tax return and they didn't receive any economic impact payment, why would they if they were listed as a dependent? Then they're going to get that $1,200 plus an additional $600 for the second round. So they're going to get $1,800. And in fact, I think we might see a lot of college students pressure some parents or other folks to say, let me claim myself this year, because if the parents claimed them, they would get a $500 other dependent credit, but the college student can get that $1,800. The education credits play a role there. Don't want to get too deep into that rabbit hole, but yeah, I think you're going to see a lot of people claim themselves in 2020 that were dependents in 2019. I got a great question about, is there a deadline for employers to opt in? I don't know, actually. That's a great question. I haven't seen any deadline for that. And so I think that's something where we just need to start pressuring our employers to say, hey, you going to do this? You going to do this? I have not known of, I don't know of a deadline yet. Another question in the QA, who keeps the money if the FSA isn't rolled over? I believe the employer does. that would be the wrong incentive. That's true. If the employer has an incentive to keep the money, would they open it up? Hopefully they would, because it's going to be better for their employees, and it's a pandemic going on, right? Another big change, and I've got a couple slides on this because I want to stress it. The earned income tax credit and the additional child tax credit are based off of your earned income. And in 2020, a lot of people suffered a drop in their earned income, quite a substantial drop. And so the law will allow folks to use their 2019 earned income to calculate these credits if their 2020 earned income is less than a 2019 earned income. And we've seen this before, actually. The California wildfires and other disasters, you could actually use the prior year earned income if you suffered a pretty catastrophic loss in the current tax year, basically. So this is the chart from I think it's the Tax Policy Center. So this is the famous chart of the earned income credit for 2020. You got your maximum credit here for 3 children at $6,660. Max credit for 2 children is a little bit less. 1 child is a little bit more than half. And then if you have no children, you're down here, the childless workers, you can get about 538, right? So it may be hard to read some of these numbers. I apologize for that. But what I really want you to see is the steepness of this curve, right? This is for every dollar, if you have 1 child, for every dollar of earned income, you get 35 cents. And then if you have 2 children, you get 40 cents of credit. And then for 3 children, you get 45 cents of credit. And so every dollar is pretty important. So if you're over here kind of near the plateau and you've suffered an income drop and you're now over here lower, you're going to get a lot less earned income tax credit and additional child tax credit. And so we'll see how that affects things in just a second. I also want to take a second to talk about this end of the graph. You know, I compare what we're in now to the Great Recession, and I saw people in 2008, 9, and 10 coming into our VITA sites, and they were used to making $60,000, $70,000, $80,000, and then a spouse lost their job. Their wages were cut, their hours were cut. You know, they suffered some economic distress. And so they used to be over here in 60,000, 70,000, which is kind of off the chart, getting none of the earned income tax credit. And suddenly they found themselves making 40,000. And so maybe they were over here, or maybe they found themselves making 30,000. And so people would really suffer economic distress, but they'd come in to get their taxes done, and they would literally hug my volunteers because they'd be getting a $6,000, $8,000, maybe $10,000 tax credit, and that meant so much to that family. You know, if you're used to making $60,000 and you're making $30,000, but you get a $10,000 tax refund, you can get caught up in your bills. That's a down payment on a car. You can maybe buy some durable goods. Maybe your washer went out and you've been going to the laundromat, and now you can buy a washer and put back in your home. Like, it really was visceral for people. And so I think we're going to see a lot of people newly eligible for the earned income credit compared to the prior year or even the past couple years. And so I think earned income tax credit marketing needs to be hit hard as people become eligible based on their economic circumstances. In this graph, let me just mention, it's down here in the tiny print. This is for non-married filing joint. If you're married filing joint, the plateaus are out just a little bit farther, about $6,000 extra that the plateau extends. Okay, so what does it look like in terms of raw numbers? Well, let's say you have a single parent with 3 children. In 2019, they made $15,000, and then in 2020, they made $5,000 because they suffered so much economic loss. So let's do some computations. If you look at their 2020 income, well, their earned income tax credit, they're only going to get about $2,261. Right, that's that 45% or so. It's close. It's in a table, so it's not exact. And their additional child tax credit is only going to be $375, because for the additional child tax credit, you have to have earned income over $2,500 in order to generate that additional child tax credit. And so only over the $2,500 by a little bit. Well, since the law allows you to use your 2019 income, if it's higher than 2020, the 2019 income generates a max EITC of $6,660. So that's the maximum you can get. And then the additional child tax credit is $1,875. So if you add these numbers up, being able to use your 2019 income instead of just relying on your 2020 is about a $6,000 difference. So again, another big marketing push is required here to let people know, hey, you can use your prior year earned income if it's greater than your 2020 earned income, right? And there's no requirement. You just tell the software and it's going to run the calculation. So you don't have to have suffered anything major. It's just, were you affected by COVID? And I think nearly everybody can raise their hand. Yeah, I've been affected by COVID. And there's really no other extra requirement for that. I do have a note here on unemployment income. Unemployment income might raise a person's AGI. And so they will start to phase out just based on their AGI. So it is a complex scenario here, but that's the nice thing about the software. We can just put it in and let the software kind of run the numbers for us and see which is best. So a big push, I think, is needed on those EITC changes to let people know, hey, we often tell you your 2019 tax return is optional when you come in to get your taxes done. You might want to bring it in your 2019s just so we can input those numbers and see what the difference is. Some other recent changes, itemizing medical expenses. My God, this has changed so many times over the years. It used to be 7.5%, and then they made it 10%. And then it was 10% if you were under 65, and if you were 65 or older, it was 7.5%. And then it was 10%. And now it's finally permanently 7.5% of your AGI is the hurdle that will allow you to start itemizing your medical expenses. And hopefully they leave it here, because I don't want to dedicate any more thought to this new threshold. It was especially annoying because, again, people aren't itemizing, and so it's been more an object of curiosity by folks. Big change is the tuition and fees deduction, which had been extended every so often. It was never permanent, but it was extended every couple of years. It has been eliminated for tax years 2021 and beyond. It's a permanent elimination. And what they've done is they've increased the phase out for the lifetime learning credit to match American Opportunity. So this is great. Tuition and fees was, you'd often have to run the numbers to say, okay, what's better, lifetime learning or tuition and fees? And you can make a case that tuition and fees was better when you included the state taxes. And it was one of those optimizing calculations that we shouldn't have to do. The taxes should be easier than that. And so they've kind of listened to people and they've made it easier. So your education benefits now are kind of in a collapsed way. Your American Opportunity credit for generally your undergrads, and then your grad students can access lifetime learning credit, and that's it. We don't have to worry or think about the tuition and fees deduction. We talked early on in the presentation about your charitable contribution that you made to a qualifying charity. That was that $300 deduction that was above the line. It contributed to the calculation of your adjusted gross income. Well, they changed that for 2021, and now it is $600 for a married filing joint. And so everybody in 2020 was saying, hey, is it $600 for married filing joint and then $300 for everybody else? And we had to say, no, it's $300 for everybody. And now once we've gotten that message out and people expect the $300, we have to come out and say, no, actually it's $600 for married filing joint. And I guarantee you somebody's going to say, well, wait a minute, shouldn't have been $600 for 2020? And we're going to have to say, no, Congress didn't do that. And they're going to say, well, that's not logical. And we're just going to do that shrug thing again because taxes, right? So $600 for married filing joint, $300 for everybody else. Same rules apply. Cash contribution to a qualifying charity, not your donor advised fund. And they made a little tweak. The change is it is from AGI now. So this won't contribute to for AGI. So you won't use this to calculate your AGI. It'll actually come out of your AGI after it's been calculated, but before you take a standard or itemized deduction. So when I think about this, it's a lot like the qualified business income deduction or QBID. It's after your AGI, but not before you get to the standard or itemized deduction. So just that's one of those things this coming weekend when you're on your Zoom cocktail party, you can be like, did you know that the charitable contribution is from AGI in 2021 and not for AGI? And everybody will be like, wow. Okay. Tuition assistance from employers to pay student loans, that was extended. So if you're, the CARES Act kind of changed some of those rules where if you were used to getting tuition assistance from your employer, you could take that and use it to make your student loan payments to help pay off your student loans. And that has been extended out to about 2025. And so that's a big change for people whose employers provide that tuition assistance. That's going to be very helpful when we start kind of repaying our student loans. And now I have the crystal ball. And the crystal ball is here, and it's going to be on every slide that comes up because we're going to look into the future. But you know, our crystal ball here is very cloudy. And so we're going to look into the future, but it's very uncertain. And so we're going to talk about what could happen. And so this isn't a guarantee of what will happen, but it's what the future might look like. So let's talk about the future, knowing that the future isn't written yet, to use a Back to the Future reference, but we're also not going to hold Andrew liable if these things don't happen. So let's look into the future. President Biden released his tax plan. And so there is talk of an additional $1,400 in additional stimulus payments. There's been some discussion about including more dependents. Can we include adult dependents or maybe dependents who are in college who are not child tax credit eligible, but maybe should still be included in these calculations? So there's this talk of the $2,000. We've already received $600, so this would be an additional $1,400 to make up for the full $2,000. So this is kind of on the table in discussions a little bit. The child tax credit for 2021, making it fully refundable. So instead of having it only be partially refundable, only the $1,400, make the full thing refundable. And instead of forcing people to meet this calculation, let's just make it, again, refundable. And let's take the child tax credit and increase it to $3,600 for children under the age of 6. And then if you're 6 or older and under 18, let's make the child tax credit $3,000. And there's been some additional discussion of, hey, can we send this out to people instead of a lump sum at tax time? Can they get it monthly? There's been some discussion around that, kind of reminiscent of the advanced EITC that kind of didn't work out a couple of years ago, that the employers could provide to people through their payroll. And notice here, it's for if you're under age 18. And so normally child tax credit is for those under 17. You have to be under 17 by the end of the tax year. There's talk of moving it to 18. So your 17-year-olds who have never qualified for the child tax credit would then qualify. And this would be temporary increases, right? But once you make a temporary increase, you can then make a case for a permanent increase, right? And so these are kind of discussion points on the table. There's also discussion around reforming the earned income tax credit for childless workers. So it's, again, just about $500-ish right now, and it could be a lot more if they decided to increase that calculation. They could also include more workers. If you don't have a qualifying child, it's limited to those between age 25 and 65, and so they could open it up to older workers as well. Again, see that crystal ball in the corner? We don't know. It's all very fuzzy. This is a big change, and I speak of someone who's got 2 kids in daycare. Child and dependent care credit, expanding the expenses that qualify up to $4,000 for 1 child and $8,000 for 2 children. Right. As of right now, they're $3,006. And taking the tax credit, which is in general 20% for most people, so 20% of the $3,000 or 20% of the $6,000, taking that percentage and upping it to 50% tax credit for all families under $125,000, and then slowly phasing it out for families up to $400,000. A lot of discussion going on about this. What happens if you are putting money in a dependent care FSA? And is that going, when you put money in your dependent care FSA, you save the tax rate of your federal and usually your state, depending on if your state is nice or not. What happens if you put money in the FSA? Can you then use the credit, or are you going to be locked out of the credit? Is everybody going to want to change their dependent care FSA so they can get the 50% credit instead of saving whatever their marginal tax rate is? So still lots of discussions there. This was also considered temporary. And so I think the push is going to be to make it permanent once people get excited about these provisions, but they are just kind of looking at just for 2021. And it was thought early on, hey, this is going to pass pretty quick. And now people are kind of walking those discussions back. May not be as quick to pass. One more thing to talk about is the Secure Act 2.0. And so in the end of 2019, we had the Secure Act. It was a lot of retirement changes. And now there's discussion about the follow-up to that, because there are maybe some more retirement changes that could have bipartisan support. And that's where I've got here under negotiations. It may actually be easier to pass retirement legislation versus other laws, right? Retirement legislation tends to be less controversial. So for example, some of the items that are being bandied about, right? This is not actually law yet, but when someone enrolls in their defined contribution plan, automatically enroll them, or when someone starts at an employer that has a defined contribution plan, automatically enroll them in the plan, and then have automatic escalation of your contribution percentage. So every anniversary, their contribution percentage goes up maybe 1% until they hit a maximum. To encourage small businesses, maybe there could be some tax credits to encourage matching contributions. So small businesses tend to not provide that matching. What if they were given some tax credits to kind of nudge them towards offering matching? Increasing RMD to 75. Secure Act increased it to 72 for most folks, and now it would increase to 75. And then maybe taking RMDs and saying, you know what, if you have 100,000 or less in your retirement accounts, there's no RMD required. So basically let people with smaller accounts kind of hold them as maybe a reserve and not forcing them to pull that money out. And maybe increasing those catch-up provisions. So increasing them to much larger amounts for people who are older, looking to kind of use those catch-ups to increase their balances. So far from a final bill, but it is all possible.